stay the course. We're going to have I don't know what it will be, but we will have another crisis. We will have a recession at some point. I don't know when it is. Suppose that Armageddon comes. Suppose, in fact, we have a worldwide nuclear war that is threatening to destroy the planet. Well, let me tell you, worrying about your investments will be the last thing on your list. Just stay the course, and you'll be okay.
Dr. Burton Malkiel, the Chemical Bank Chairman, Professor of Economics Emeritus at Princeton University, and the author of the absolute must-read book, A Random Walk Down Wall Street. It is such an honor to welcome you on the show, Dr. Malkiel. Thank you so much for taking the time today.
I'm delighted to be here.
Well, I'm excited to have you, and you are an absolute legend. And your book, which just celebrated its 50th year in print last year, is one of those seminal books in finance that is a must-read. And I remember when I was asking around for books to read early in my career as a financial journalist, that was one of the top recommendations. So I'm so excited to have you on. And I do want to discuss the book, and maybe a place to start, Dr. Malkiel, is what was it that made you want to write A Random Walk Down Wall Street just over 50 years ago? What was the genesis of the book for you?
Well, I was very skeptical 50 years ago about how good active management was. I knew there were a lot of active managers who said they were great stock pickers, and there was no question about the fact that they could pick a portfolio that would beat the market. And that was the whole thing. Beating the market was very easy when you were a Wall Street genius. Now, I started my career working on Wall Street. I worked for Smith Barney for some time, which was actually one of the top research firms on Wall Street. And I just became very skeptical that the emperor really had any clothes. Could they, in fact, do it? And I was putting together some statistics, and I thought to myself, I'm not at all sure that that's going to work. And I'm not at all sure that they can do it. And I became, I sort of have been in the business world and the academic world throughout my life. But as I became an academic and started to do research myself, I came to the conclusion that, what the best thing might be was to simply buy and hold an index fund that held all the stocks in the market, and that these people on Wall Street who said they could beat the market really couldn't do it. And so the sort of genesis of this was being very suspicious of what then went for received wisdom. And I wrote the book 50 years ago. And basically the thesis of the book was that a blindfolded chimpanzee throwing darts at the Wall Street Journal. And in those days, we didn't have the computers, so that we actually looked at the actual newspaper to get our quotes from the day. So the image was the monkey throwing darts at the Wall Street Journal could select a portfolio that would do as well as the experts. Now, I didn't literally mean you should throw darts. Perhaps the right analogy was to throw a towel over the stock pages and just buy everything. So that was the genesis of the book 50 years ago. And the reaction was, this is about the stupidest idea that you can possibly imagine. A professional reviewed my book in Business Week and said this was just a piece of garbage, that it was absolutely crazy. And in fact, when 3 years later, Jack Bogle at Vanguard started what was actually the first index fund. It was a disaster. The IPO was supposed to be $250 million. And then the bankers said, well, let's downsize it to 150. When they finally closed the books, $11 million was sold. And the fund, the first index fund, stayed at under 25 million for years. It was a total failure. It was called Bogle's Folly. And that was the sort of genesis of the idea. And in doing the 50th anniversary edition, I've sort of looked back at that history and was sort of pleased to find that, it was actually right. Because what we see now today, Standard & Poor's does a wonderful study twice a year. It's called a SPIVA study, where they compare Standard & Poor's indices with active managers. And every year, 2/3 of the active managers are beaten by a simple index. And the 1/3 that win in 1 year are not the same as the 1/3 that win in the next year. So that when you compound it over 10 and 20 years, what they find, and it's a consistent finding, that 90% plus of active managers do worse than the index. So look, I'm not saying it isn't possible to beat the index. There are some Warren Buffetts of the world, although even Warren Buffett over the last 10, 15 years has not beaten the market. But look, it's possible. But if you try to go active, you're much more likely to be in the bottom of the distribution, in the 90% rather than the 10%. And so the wisest thing for investors to do is just keep putting their money into a broad-based index fund. Don't think you're so smart that you can beat the market, because you probably can't. And don't think you can time the market, because I'm sure you can't. And this is the way to build a retirement fund, and for anybody to build wealth in the market today. And I'm just pleased to say that I believe in the thesis that I advanced 50 years ago, even more today than I did even then.
What a great frame up to the conversation. And you mentioned, it was just, what was it, 3 years later after the book, Jack Bogle starting the first index fund, and they had trouble raising. I have a quick question for you. Did you invest in that first index fund? And I think also,
as a matter of fact, I did. I used to joke with, I was also a director of the Vanguard family of funds for 28 years. So I knew Jack well, and I used to joke with him that he and I were the only investors in the fund. That of that 11 million that they started. Not that I had much money at that time, but we were both the early investors in the fund. So absolutely.
And I'm like looking.
I eat my own cooking.
I love that. Well, also I noticed in the book too, in the 50th anniversary edition, you wrote an investor with $10,000 to invest at the start of 1977, when the first index was available, would have a portfolio worth north of 2 million, 2,143,500 at the start of 2022, assuming all dividends were reinvested, and an investor who purchased shares in an actively managed mutual fund with the same investment would have seen it grow to 1,477,033. So you can see that the index fund handily beat if you were to do the actively managed mutual.
No, that's absolutely right. And the other thing that has actually pleased me about the book are the number of people who have written me and said, uh, I never had a lot of money. I never earned a lot of money, but I put a little money into an index fund, as you suggested, every pay period. And I'm now having a comfortable retirement, and I want to thank you. And I think that's what probably pleases me more than anything else. That, in this world where, there's sort of a lot of complaint about the unequal distribution of wealth, what's just amazing is that if you could just save $23 a week, one day a week that you used to go many days a week to Starbucks for a latte and a sausage roll. Put it aside, have coffee at home or in the office. Might not taste as good. And just put that aside, put it in an index fund. And if you do this regularly, and started that in 77, when the first index fund was available, that again, you would have something like $1.5 million plus today. So it is possible, even for people of the most modest means, to build a sizable retirement portfolio. One of my favorite books, there's a book called The Millionaire Next Door.
Mm-hmm.
And the authors actually interviewed millionaires. And it wasn't that, the only millionaires are ones who were born with the silver spoon and a big trust fund. But those who were saving regularly and investing in the stock market, it really is possible. Hopefully my book has helped put people on the right path to having financial security.
Mm-hmm. Even going back to the reception of the book, and you mentioned that it was criticized, it was trashed in the pages of Business Week. You wrote that on Wall Street, the term random walk is an obscenity. It's an epithet coined by the academic world and hurled insultingly at the professional soothsayers. Taken to its logical extreme, it means that a blindfolded monkey throwing darts at the stock listings could select a portfolio that would do as well as one selected by the experts. So my question to you is, when did that start to shift, the criticism of it? Or maybe are folks still kind of the mindset that they are, I guess, a genius and can certainly beat the market today? I am curious about that, like when the reception started to shift and change.
I think it started to shift because the evidence rolled in. I would say the first 20 years of the book and the index funds that were pioneered by Vanguard, as a commercial success, neither was very popular. But as the evidence rolled in, I think people just got the clue that, look, the fact of the matter is that this is the way to invest. And I think I want to give Standard & Poor's a lot of credit because there's a lot of publicity given to their so-called SPIVA reports, Standard & Poor's versus the indices versus active management. And people realized that, look, it's not just a crazy academic idea. It actually works. And one of the reasons it works is that, the paradox is it's not that Wall Street people are stupid. They're not stupid at all. They're some of the smartest people I've ever known have worked on Wall Street. But the paradox is that because there are so many smart people looking at every individual stock, doing the research that they do, and much of it is very, very good, doing that research, that the price in the market basically reflects all of that information. And what people were able to do a generation or two ago, where they would go and travel, the security analyst would travel around and talk to management and get inside information, get these tips, and then be able to pick the right stocks. You can't do that anymore. The SEC, with its fair disclosure requirements, as one Wall Street analyst correctly put it, it means no disclosure, because if a company has got some really big information, they can't tell the one select analyst. They have to put it out in the public. And so information gets reflected very quickly into stock prices. And it's harder and harder over time to get an edge. The second thing is that, look, Wall Street might not be the oldest profession, but it certainly is one of the highest paid. And the fees for buying an actively managed fund might be, it sounds low, 1% a year. But you can now buy an index fund for 2 or 3 basis points, a basis point being 1/100th of 1%. So essentially for zero fee. And that's a huge difference. That if you can get a portfolio and pay zero versus paying 1% or sometimes even 2% a year, that's one of the reasons why you're bound to outperform. You know, one of the things I like to say is it's very important to be modest about what you know and don't know about markets. And the only thing I am absolutely sure about is that the lower the fee I pay to the purveyor of an investment service, the more there's going to be for me. And my friend Jack Bogle actually put it even, it's my favorite quote of his, in the investment business, you get what you don't pay for. And so today, more than half of investment funds are indexed. Who are the main money managers in the world today? Number one is BlackRock. And what are BlackRock's funds? BlackRock has not a monopoly, but they've got most of the money that are in index funds and exchange traded funds. And number two is Vanguard, who pioneered these index funds. So the fact of the matter is that the market finally has caught up to the idea that it is not a silly academic idea. It actually works. And the core of every investment portfolio, be it for an individual or even an institution now, people realize ought to be indexed.
Hey there, I hope that you are enjoying this interview. If you can, please take a moment to hit the like button, subscribe to the channel, and ring the notification bell. This will keep you up to date with all of our new interviews, and it will also help us grow this channel and continue to bring some amazing guests. Thank you so much for your support, and enjoy the rest of the interview. Speaking of Jack Bogle, didn't you two disagree on exchange traded funds? Am I recalling that correctly?
We did. That was actually one of the few things that Jack and I would fight about all the time. I thought this was absolutely a great idea, and it would be a great idea when I was on the board member of Vanguard, because Vanguard didn't advertise. Their idea was the lowest fees in the industry. That was what the mantra of Vanguard. And so most mutual funds so-called pay for distribution. If you've got an actively managed fund and you want a broker to sell it, you say, look, if you sell this fund, we'll give you an extra little commission. So Vanguard wouldn't do that. And so you had to, buy Vanguard through word of mouth because a friend recommended it. There was no advertising. And this way, if you had an exchange traded Vanguard fund, then all the brokers could sell it and you didn't have to pay them anything. The broker would sell it, charge a commission if the broker wanted, but this was a way for Vanguard to actually grow. So Jack's view was that exchange traded funds were the instrument of the devil. And the reason he thought it was that basically the exchange traded fund simply means that you can go and buy and sell, and you'll kill yourself as you tried to buy and sell, because you'd always buy at the wrong time and sell at the wrong time. And I remember when Jack and I would have an argument, Jack would say, who in their right mind would want to buy a market fund at 10 o'clock in the morning and then sell it at 2 o'clock in the afternoon? And that's what exchange traded funds will have you do. It's terrible. People will cut their throats on it. I want nothing to do with it. And that was why until a new CEO came to Vanguard, Vanguard didn't have exchange traded funds. And it's one of the reasons why BlackRock is number one today, rather than Vanguard, which really invented the whole thing, and why they're only number two. Although in terms of fund flows, more money is going to Vanguard today than is going to BlackRock. And, sometimes when I think of Jack, who, I disagreed with him on this, but so it's just a wonderful person. I often think today, Jack would roll over in his grave if he knew that the SEC had just allowed a spot ETF on Bitcoin. I could just, he would be just so livid that we were having people go and buy and sell that, and something currency that goes up $1,000 one day and down $1,000.
Okay, I take it then, Dr. Malkiel, you have an opinion on Bitcoin with the recent spot ETF news. What's your take?
Look, if I want to have a currency and I want to buy a cup of coffee at Starbucks, I don't want a currency that can go up or down 10% in value in the matter of days. This is not a useful currency. Now, I'm not saying there aren't some uses for it, but when I think of the uses that there are for it, and there are, I think this is what will eventually be Bitcoin's downfall. The uses for it would be that if I wanted to go out and buy illegal drugs, then I probably would like to use Bitcoin. I would like to hide my purchase. I don't want to do it with my credit card where people can find out what I'm doing. And if I wanted to get some money from ransomware, I don't want them to wire it to my bank account. I probably want to have it in Bitcoin. And it's its use in illegal transactions and in hiding money from authorities is exactly why you're going to see the governments taking greater and greater efforts to break the secrecy and to limit the legality of the transactions. I think eventually, to the extent that this is used for more and more illegal transactions, yep, that is a use. But I'm not sure that that's a long-term asset that I want to have in my portfolio.
In the book, you also write about bubbles and over the years and the history of bubbles. Do you think Bitcoin could also be a bubble?
Absolutely. I don't think there's any question about that. When you have something that can be 60,000, can be 20,000, can be, as it is now, around 40,000. This is a little bit very bubbly in my view. It's like the so-called meme stocks that we had a year or two ago, where GameStop, who sold video games through stores, even though they were all being bought online, because the Reddit crowd decided that this was going to be a great investment. I think this is a very good way for people to lose a lot of money. And I've got no objection to gambling. I like to go to the horse races myself. I like to sit at the blackjack table from time to time, but I do this with very limited funds, and no, this is entertainment. This is not investment.
Mm-hmm. Okay, I want to ask another question for you, and it's a topic. It has come up on this show, and I've seen it come up over the years, and you might be the right person to address it or debunk this. There have been folks who've said over the years that they think that ETFs, that they distort financial markets, and that there could be a passive investing bubble, I guess, driven by ETFs. Have you heard this argument? And if you have, could you debunk it?
No, absolutely. The paradox of indexing, of the idea that markets are efficient, is that you really need active managers to make sure that information gets reflected properly. If a drug company comes up with a cure for a type of cancer where there was no cure, and the drug company was selling at $20 a share, and it really ought to be selling at $40 a share. Well, unless some active investor comes into the market to buy that stock and push it up to the price that it ought to be, markets will be inefficient, and markets won't work well. So you do need some of these active people. You do need active traders to make sure that information gets reflected properly into the market. Now, a little over half of the market is indexed now. So only half of the market has active managers. And some people are saying, no, there aren't enough active managers. If the market were 95% indexed and there were only 5% active managers, that would be enough to get the information in. As long as we are in a free market and a capitalist system where people can enter the market it's inconceivable to me that there won't be enough active managers to make the market efficient, to make sure that information gets reflected. And that'll be true if 50% is indexed, 75, 90, or 95% is indexed. But look, just for the sake of argument, suppose we were 100% indexed. There were active managers went the way of the dinosaur. There were none of them around. And we have this drug company selling at $20 a share. And I'm just an individual around, and I say, hey, this really ought to be worth double what it is. It's inconceivable to me that as long as we have a free market, that there isn't somebody who's going to go out and say, hey, I'm going to buy this stock. I'm going to buy it until it's 25. I'm going to buy it until it's 30. I'm going to tell my friends. It's inconceivable to me that in a capitalist system where people are incented by profits to go and make sure that information gets reflected, that I'm not going to worry even when indexing is 75%, and I think it may well be at some point, or even higher. There'll always be somebody who's incented to do the research and to go into the market and find anything where the price does not reflect the true information. So no, I'm not worried. I think that's I think that's a bugaboo. And I think, let me tell you the other thing, that today, this is the sort of argument, because of indexing, the market is much too narrow, and the Magnificent Seven are responsible for 3/4 of the increase in the indexes. And this is terrible. It's all because of indexing. These terrible, this has made the market very inefficient. Look, it may very well be that some of the Magnificent Seven are overpriced, but it may also be that the market's actually quite right, that we have a technology change, artificial intelligence, that will be as important, if not more important, than the internet itself was, and that these are the correct prices. The one thing about an indexer is don't ask me whether Google is too high or too low, or Microsoft is too high or too low. I'm going to buy everything, and you guys who go and bet one way or another, I am sure you're going to be wrong just as often as you're right. So I'm not worried about indexing, making the Magnificent Seven too magnificent, or that they're going to make the market inefficient. There'll always be somebody in a capitalist system who will be around as long as there's a profit opportunity. Somebody's going to seize it.
Mm-hmm. And you were mentioning efficient markets and the efficient market hypothesis. And can we explore that and what folks get wrong about that? It gets brought up in the media, and I know I'm a former member of the press. It gets, so we get it wrong. So can you just kind of help us understand the hypothesis and what people get wrong?
The market hypothesis means that information gets recorded into stock prices so that if there's the cure for cancer, if there is a new clean source of energy that a company has that's going to be a big winner, it'll get reflected in the prices. What people get wrong is they say that means that prices of stocks are always correct. It doesn't mean that. In fact, prices of stocks are always wrong. What it says is They're always wrong, but nobody knows whether they're too high or too low. And the market gets it right more often than any active manager or anybody who thinks they are smarter than the market. So it doesn't mean the prices are always right. And it doesn't mean that there can't be bubbles. There can be bubbles, but you can never time them. You can never know when you only know you are in the bubble after it's popped. And let me give you an example. The person who coined the term irrational exuberance was Alan Greenspan. And we did have a bubble in internet stocks that crashed in early 2000. And Alan Greenspan is often the guy who is credited with he saw it, he understood it, called it irrational exuberance. What people forget is that Alan Greenspan made that irrational exuberance speech in 1996. If you had bought the day after Alan Greenspan's irrational exuberance speech and just held through today, you would have done beautifully because the market went up for the next 4 years. So it doesn't mean that there wasn't a bubble, that it wasn't wrong. Sure, it was wrong, but nobody knew the time that it was going to break. And the Alan Greenspans of the world who labeled it irrational exuberance, labeled it that way in advance, and you couldn't have made any money by acting on it. Now, let's talk about the meme stocks. Hedge funds, what they try to do is they try to look for those kinds of bubbles, and they want to short the stocks. They'll sell them short so that they can buy them back later. And so when the meme stocks were going crazy, it was a bubble. Absolutely. Market was crazy. It wasn't right. But remember, one of the hedge funds that went bankrupt betting against the memes, betting against the meme stocks, because as the mantra of the hedge funds is, the market can stay irrational longer than we can stay solvent. So efficient markets means that you're not going to be smarter than the information gets recorded. You're not going to be smarter than the market. The market's not always going to be right. It's always going to be wrong. Sometimes it's going to be spectacularly wrong. But don't think that you're smart enough to know when those periods are. And if you start betting against it, you're going to be wrong more often than you're right.
This is so great. I'm learning so much from you, Dr. Malkiel. Let me ask you this, because I come from the world of financial media, and there's always discussion of like, what's your take on the market, where markets are headed, and even the economy and the macro picture. Can we get your take there? And it sounds like maybe that doesn't even matter, the commentary around that, or no one can actually.
Well, it matters, but nobody knows, but nobody can do it. I have no idea where the market's going today, next week, next month, next year. I do believe in the United States of America. I do believe in our dynamic economy. I think in the long run, this is a good place to invest. But where the market's going to go next week or next month, I have no idea. Economists don't know where the economy is going. If you want an example of this, as I'm sure you know, the governors of the Federal Reserve, our central bank, when they meet, the governors are always asked for their forecasts of where's the economy going to be the next month, the next year? Where are interest rates going to be? And these are called their dot plots because they are actually putting their forecasts down. Well, look at them over the last several years. They've been completely wrong. Completely wrong on whether a year ago everyone was talking about we're going to have a deep recession. And now we're having a soft landing. We're having a no landing. Or we really are going to have a recession. It's just been put off. Nobody can do this. Professionals can't do this. So it's useless to try. And I'm a big buy and hold believer because you'll never get it right. You'll never get the economy right. You'll never get where interest rates are going right. So the best thing to do is to just buy and hold for the long run and do something for people accumulating a retirement account. Keep going, just regularly save, and you will take an advantage of dollar cost averaging, because the beauty of just putting money in regularly is when you have these downdrafts in the market, and they will come, undoubtedly we'll have them in the future. But when you're putting a regular amount of money in, you're able to buy more shares of your stocks and ETFs when the market is down. And the beauty of this dollar cost averaging is that the average of the securities that you own will be, the average price will be less than the average of the prices at which you bought, because you're buying more shares when the price is lower than when the price is higher. And this is a great way for people to invest. Just ignore all the, I don't want to say, I'm not trying to dissuade people from, good financial writing and good financial commentary. I'm a consumer myself, but don't think that any of those predictions should be acted on.
Mm-hmm. So do you not even, you don't even try to like prognosticate because it's pretty much useless?
Not about where the stock market is going, and frankly, not about where the economy is going. I think one does have to have some long run view about the strength of an economy and a strength of a capitalist system, which I absolutely believe in. And I think that capitalism can be the greatest creator of wealth than any other system in the world. I think maybe that's a prediction that I'm willing to make, because I wouldn't want to be a long run investor in the stock market if I didn't believe it. But should I ignore someone who tells me we're going to have a recession later in 2024? Should I ignore someone who tells me that interest rates are going to go down to 1 or 2% by the end of the year? Yes, I think that I want to ignore, because those are predictions that I think are going to get me in trouble rather than be helpful.
I want to bring up a topic with you just around retirement. And do you think, like, I mean, maybe I'll focus here in the US. Are we even prepared for retirement? Or do you think we're going to eventually face some sort of retirement crisis with people not being ready or running out?
Absolutely. I couldn't agree with you more. Most people are entering retirement being completely unprepared for it. And this is one of the reasons why I do think that it's extremely important for people to save and invest and This is where I think financial programs like yours can be extremely helpful because we are unprepared. And how easy it is by just foregoing that latte once a week for most people to become prepared. And one of the reasons that I wrote the book is hoping that people would read it and people would do the right thing to start saving and investing so that they would be prepared. But half the people in this country are going into retirement with nothing but Social Security. And I think that is very, very bad. And people are going to have a less healthy and happy retirement because of it. So I do think it is a serious problem, and it's a problem that can be remedied. And hopefully, the advice that I've given will help people cope with it. It's also the case that Social Security itself is likely to be actuarially, it will be in serious trouble within the next decade. And something is clearly has to be done with Social Security. And unfortunately, our politicians are not likely. This is a presidential year, and I don't think you're going to hear anybody offering suggestions of how we can shore up the Social Security system. So, is that heading to a crisis? Yep. And unfortunately, we'll probably only fix it when it's much nearer to a crisis because I don't expect any action over the near term. But I think you put your finger on what is a serious problem. We are in general not prepared, and we're living longer. And so we're in a situation now where maybe 10% of the babies born today are likely to live to 100. And that means the amount of resources that one needs over many, many years of retirement is very important. But, when Social Security started, people lived for a year or two collecting Social Security. Now they live for decades collecting it. So, yes, it is a serious problem. And one way to help solve the quote retirement crisis is for people to start saving modest amounts each week, each month, regularly putting it into a broad-based index fund and having a nest egg when they're ready to retire. That will serve them very, very well.
Mm-hmm. Dr. Malkiel, would you be willing to share your own story and background and, even going back to growing up and also like you mentioned earlier in the conversation when it comes to indexing, you eat your own cooking. You were one of those first investors with Jack Bogle in Vanguard's first index fund, but your background and how you became an economist.
My own background was I grew up in a tenement house in Roxbury section of Boston, and I didn't start investing as a kid because I had no money, but I did eat my own cooking. I did start when I had a salary, even the first job of putting small amounts of money aside and investing. And did have and do have a retirement portfolio now that was invested in broad-based index funds. So I think I'm certainly one example of somebody who is now living very comfortably in, I'm going to put retirement in quotes since I still am active doing a number of boards and committees, but certainly with a retirement portfolio that allows for a quite comfortable living. But it can be done, and I am personally an example of someone who was able to do it.
Yes. Well, I have to say, Dr. Malkiel, I have enjoyed getting to talk to you and learn from you. I feel like I've gotten to be a student for this hour and just learning so much from you. I want to give you the last few minutes to let folks know where they can pick up your book or read any of your work, anything that you want to plug on your side. And also, let's leave the folks with some parting thoughts, maybe something that we didn't bring up in this conversation, or even if you want to go back and reinforce something with the audience, please take the next few minutes to do so.
Sure. Look, I am absolutely convinced that you shouldn't think that investing is just much too complicated for you. It's much too esoteric. I really need an expert to be able to tell me what to do. You can very, very easily do this yourself. And the clue is invest in the growth of the U.S. and even the world economy by buying index funds. They're easy to get. You could go to a discount broker and you can buy at no commission an exchange traded index fund. I've listed a number of them in my book. And so my sort of first thought to tell people is when you're in your 20s and 30s, you think you will never get old. You will never have to rely on retirement savings. The world, the time passes and passes much more quickly than in some cases one might like. So start putting a little aside. You don't need experts. You can get a hold of my book, which lists the exact low-cost ETFs that would work and how you can go and buy them. And don't get carried away in thinking that you need a high-priced expert to tell you how to do it. And so I think the sort of lessons would be start saving and investing regularly in index funds and avoid mistakes. People just shoot themselves in the foot. They think, no, I don't want to buy some boring index fund of stocks. I want to buy GameStop, or I want to buy American movie theaters, which was one of the other meme stocks that was going crazy, even though we had a COVID epidemic and nobody was going into movie theaters. Don't try to think that you can do that and do that better than anybody else. And don't panic when there are crises. I like to tell the story. I had become the kind of informal advisor to a lot of widows at my university who would come to me for advice. And I remember at one point, this woman who came into my office in tears during the financial crisis of 2008, when it looked like the world was coming apart. And she said, I've got to go and sell all of my stocks because they had just gone down 20% in the last month. And I can't take it. I can't sleep at night. Uh, Stay the course. We're going to have I don't know what it will be, but we will have another crisis. We will have a recession at some point. I don't know when it is. We could have, the world situation is so precarious now. We could have a wider war. Whatever it is, there will be those crises. And just in the long run, we are going to get through. And suppose I'm wrong. Suppose that Armageddon comes. Suppose, in fact, that we have a worldwide nuclear war that is threatening to destroy the planet. Well, let me tell you, worrying about your investments will be the last thing on your list. Just stay the course, and you'll be okay.
I think that's a wonderful place to end. Dr. Burton Malkiel, author of the Random Walk Down Wall Street book. It has been an absolute honor having you on. Thank you so much for being so generous with your time, your ideas, all of your wisdom. I really appreciate you, Dr. Malkiel.
I really thank you so much, and I thank you for all the great questions. You're terrific. Thank you so much.
Thank you. You are so wonderful.